one of the most complex parts about tax time in Australia is tracking your payouts from trust sources. So this means payouts coming from ETFs, exchange traded funds, payouts coming from unit trusts, managed funds, and the most complex of all, stapled securities. So I've now jumped into a holding Vanguard's VAS. Now I'm showing you VAS because it has a few additional little things that were sort of worth mentioning. We have a lot of functionality we've built over the last few years regarding ETFs. So what you see here, if I hover over this one here, which is 16th of July 2019, we've got an indicator saying that's unconfirmed. We obviously want to get that into a confirmed state. But what we actually recommend for ETFs in particular is that you actually don't confirm these payouts during the year. You obviously want to make sure that you've got your cash, the net dividend in your bank account, and that's obviously important. But what we actually do at the end of the year is ETFs. We get basically the final tax components from the ETF providers. So from Computershare in particular. We also source the data for the LIC market shares, and we can update this information in Sharesight. So until that time, you'll have this little sort of warning indicator, and I'm just going to read out this because it's probably a bit hard to see. So the components that make up this distribution are likely to be updated at year end. Please update if necessary once you receive your annual taxation statement from your ETF provider. So there's a little indicator there that perhaps you want to keep that unconfirmed until year end, because at that point we will update. We will update the ETF components. So step one is running your taxable income report. Now I've run it for the financial for the year 1st of July 2018 to 30th of June 2019. I've got an American date format at the moment. Now you need to run it obviously for a tax year. For you, like you'll be running it for the 2019 and 2020 tax year. We split our taxable income report into several sections. The first section is we group everything into what we call the non-trust income section, and this is all local income in Australia. So all local income is grouped into two categories: non-trust income and trust income. The non-trust income means you've got payouts coming from non-trust sources, so standard equities, interest accounts, and the like. LIC payouts are treated as non-trust income. We've also got another section, which is the trust income section, and again, we group everything together. And so managed funds, unit trusts, ETFs are all grouped down here. Now, the reason we do that is because the government treats those income sources differently at tax time, and you've actually got to report on that income differently. We've got foreign income as well, so three major sections to the form. So that's anything that's not anything not Australia. Now, the first thing to do is, if I just scroll this along a bit, the first thing to do is just double check, and actually I've got some examples on the section here, is just make sure that you don't have any lightning bolt icons. So that just means any payout that you haven't already confirmed. It's pretty straightforward for the non-trust sections, because you typically just get a payout, and the payout is a payout. It is what it is. It doesn't change. This one's showing $88.55 franked. That's fine. But you come into each one and check the details and confirm them if they haven't already been confirmed. No problem there. One thing worth noting is this component, if you do have any LICs, there is a component that you will see on your payouts called an LIC Capital Gain component some of the time. We have added a field. This field appears if you just click this add another link, where you can actually punch in the LIC value. So if I just go and run that. But once you've confirmed your, once you've got all your LIC payouts, it is important just to update each of those payouts with LIC capital gain amount. Now, the LIC capital gain amount is treated differently at tax time. LIC capital gains can be used, you can take 50% of your LIC capital gain and it can be used as it goes as a deduction. So that's just something to bear in mind. So it is worth tracking that. So The next section, once you've done your non-trust section, is your trust section. What I want to do is I've actually just set the date here for the 2017-18 year. The reason I've done that is I just wanted to show you the trust income section. What I'm going to do is jump forward and show you an annual tax statement. Okay, so this is an annual tax statement for Vanguard. Now, it might be a little bit hard to see here, but completing your distributions for trust income does get a little bit complex, and you will get an annual tax statement for each ETF, each managed fund, each unit trust that you hold. Now, what we've done is for the ETFs supported where the registry is Computershare, we will update the tax components, and there'll be very little you need to do. For the managed funds, we don't get that end of year tax detail, so you'll need to update your tax components to bring them into line with your annual tax statement. Now, this is where I'm going to go into a little bit of detail. I'm using the 2018 year simply because I've got a good example here, and I'm going to go and update the tax components in Sharesight to bring in the components in line with the statement. Now, I'm going to run through a few values here. What we've got is we've got the first value I want to mention is our franked amount. Now, the franked amount in Sharesight is actually net of the tax. So there is actually a little formula here where you take the franked amount and you minus the tax to give you the franked value to put into Sharesight. I'll go into a little bit more detail and explain why in a minute. Number two is the unfranked amount. Now, this is called non-primary production income, generally on the annual tax statements. Now, that value goes down under the unfranked amount column. What happens is once you've gone and put in all these values, and we've got a form to do this, we can then distribute those components across all your payouts for the year, which basically result in you having an accurate cash position, as well as an accurate position for tax. So this means your performance and your tax is correct in Sharesight, and it's a really powerful tool. So the total net cash distribution on this for this customer was $23,053.38. I'm going to hop back into Sharesight for the year ending 2018, and you'll see in the net amount column I've got $23,053.42, so it's a little bit off, and there's a couple of reasons for that, but what I want to do is I'm going to go and punch in those values that I showed you on the statement, and you bear with me for a little bit. Now, what happens when I punch in the actual correct amount is we keep the cash position correct once I go through everything, but we distribute the tax component across each of the payouts for the year. So I'll just quickly go through this. Just bear with me. Now, interest, we keep blank, and the reason is because interest is actually included in the unfranked amount. Now, we have some good explanations for all of these tooltips. With good tooltips explaining all this, but I will just read out the first one to give you an indication of the types of stuff we say. So, this value is net of the tax paid franking credits for an attribution managed investment trust, and Vanguard VAS is an attribution managed investment trust. This is a new kind of type of trust. It was introduced a few years ago, and they have a different sort of reporting obligations. And we've built a bunch of functionality to cater to this. Most ETFs now, or a lot of them anyway, seem to be running as under this sort of attribution managed investment regime, and some managed funds. So each of these, we have a little tool tip trying to guide you along what you need to do. Tax deferred, that's blank. Now, AMIT decrease amount. Now this value Actually, I'll read this out because this explains it kind of nicely, but relevant for AMITs when the taxable income attributed to you is less than the cash distribution you received. This amount is non-assessable and is used to decrease your cost base for CGT purposes. Now, this value is added to your gross amount as it represents cash received that was not attributed to you for tax purposes. Now, this AMIT decrease amount is often referred to as the reduced tax. Sometimes referred to as the label is called AMIT cost base net amount excess, reduced cost base. So it's called different things sometimes, but anyway, that is the decrease amount. In this form, it was $62. And the increase amount was 0. The foreign source amount. So these are values coming straight off the statement. The foreign source amount was, where are we? 463. Discounted capital gains, okay, 1567. Capital gains, that's 1 point. CGT concession, this one's worth reading out. So the amount of any CGT discount that is included on the statement for AMITs, this is referred to as the AMIT CGT gross up amount. Now we've got this mapping on our help docs and things, so this is all probably getting a bit, might be getting a bit weird, confusing, but I will just go and say non-withholding and I'll just finish this off. 15 point, that's right. Franking credits, 7069.35, and other net FSI. Other net FSI is basically your, it seems to be pretty much always your foreign source income. There's a slight little complexity to it and it can change a little bit, but for the most part it is generally the same. Now I'm just going to move this out of the way. Now after we do all this, you'll see the net cash amount still remains the same, or it's a cent difference. I'm just going to submit that. Now, what's happened is we've now got, not only are all of our payouts accurate from a cash position, they're all accurate now from a tax position. If I jump back again, it's going to be hard to see, but at the top of this Attribution Managed Investment Trust, there's a Part A, a summary of the 2018 tax return details. Now, what they do is they have a tax return label, and that label will map directly to the Australian income tax return. In this first one, it's got to look a bit closely, but it's $3,606.42, and what I'm going to do is jump back, and the reason why I chose the earlier year was I wanted to show VAS by itself, because we've also got a income tax return section, and this is for those of you, well, this is for everyone really, just to give you a bit of an assistance, but just want to show you how this tool works. So this basically takes everything that you've put into your taxable income report, or the data you put into Sharesight, and it actually groups them up into the relevant tax return sections. So I said 13U, so here 13U, $3,606.42. What we've done is we've actually grouped everything together so it maps to the tax field on the Australian tax return, and so on. So all these other values, they all will match the values provided, in this case, on this annual tax return, annual statement for VAS. Now, of course, in a real-world scenario, you will have lots of these, or potentially lots of these different ETFs, and all those values will be taken and updated here. But I just wanted to show you a single example so you could actually see at work how this income tax return section works and can be used. So for those of you who are sending your tax data off to your accountants, this might not be so relevant because they're going to maybe take it and put it, scrunch it together with a bunch of other data that you don't have in Sharesight. And also bearing in mind, even if you're using this yourself, it's only as good as the information that you've captured in Sharesight. So if you have, if you have investments elsewhere or whatever that aren't in Sharesight, then obviously you'll need to add to these values to bring it up to scratch, ready for tax time. But we do populate kind of everything here. You've got the D8 the dividend deductions is showing as 0 because I deleted the LIC Capital Gain, and it's not in this example. But if I actually change the reporting period now, I'm just going to go back to. I'll jump to the following tax year. Obviously, again, for all of you lot, you'll be doing it for the 2019 and 2020 year. I'm just kind of jumping around a little bit for demonstration purposes. I'm just going to jump back here. And I'm going to go back into this. I'm going to go back into this one here. And I'm going to put that LIC Capital Gain. I'll just put, I don't know, $10 maybe. So I'll put $10 in there. I'm going to save that. And if I scroll down, you'll see this dividend deduction here, which is the amount of an LIC capital gain that can be claimed as a deduction, which is 50%. So it's the sum of your LIC capital gain column from the non-trust section. So just an example of one type of dividend deduction. We don't have other dividend deductions captured in Sharesight, so of course you just need to take this value and combine it with your other deductions. I have also got in this example here of this non-trust section, I've got an example of we now allow interest payments to come through into your Australian tax report, and I created so this is in a cash account, and I've got a $25 interest payment, and you'll see it displayed here. So that's basically that's basically the sort of covers, I guess, the main concepts of getting your payouts accurate in Sharesight. In summary, you've got a non-trust section. You've got included in that, you've got the LICs, you've got equities, you've got various fixed interest type, anything that's non-trust. Once you've gone down and made sure you've got there's no lightning bolt icons, you're happy with that, you roll down to your trust section, make sure that you've used this this special tool that we've built to get your tax components correct, which is the complicated bit, but also really important. One thing I didn't mention was this will only show up if you have show holding totals selected. If you don't, and I rerun that report, the totals have disappeared, and you can see a total here, but if you've got a whole bunch of different ETFs, then you'll just get one grouped total, and that won't work for you. So you do need to select show holding totals. We're going to improve this report and have these a bit more visible, but for now they're a little bit buried, unfortunately. The other thing worth mentioning is you'll see the occasional little tooltip. For example, this little tooltip, we've run this for the year ending 30th of June 2019, and you'll see that we've got this ex-date column. And now payouts for trusts, they've got to be paid in the tax year where the income was earned by the trust, not in the year which it was paid to you. In this case, these Vanguard shares were paid on the 16th of July, but even then that they were paid on the 16th of July, they actually fell into the 2018-19 tax year. And what we do is we have a little bit of smart logic around that and say that this disbursement is included in this period because the tax year for ETFs is based on when fund income is earned and not when it was disbursed to unit holders. So there's always a little bit of confusion around that. We use a combination of the ex-date and some business logic to make sure that for ETFs and unit trusts and managed funds, we put the correct payment into the correct year. Now, it is worth mentioning here, one thing I haven't dived into too much detail is stapled securities. So I think Dexis might be an example of one. There's a bunch of stapled securities on the ASX. Stapled securities are definitely the most complicated. Unfortunately, you get an annual statement which will, stapled securities issue payouts, which include trust and non-trust components. And not only do they do that, but you might have a payout that will come out on like the 1st of July, where the trust components will actually apply to the previous tax year, but the non-trust components will apply to the current tax year, which is kind of a nightmare, really. In Sharesight, we don't currently have the capability to kind of know what's what and split that out. So you'll end up with, if you have stapled securities, it's quite important. It's quite important to understand that an individual payout might actually have trust and non-trust components. And what you really need to do there is you need to separate out the trust from the non-trust aspects. And I will just dive into a holding to illustrate this, because it is a kind of key area of concern. If you, hopefully you've only got 1 or 2 stapled securities. If you've got more, there is a bit of work for you. But for example, you've got a payout, the 16th of whatever, July. You'll have one payout. What I recommend you do is, if you can work out what are the trust portions and what are the non-trust, you save one payout, which is trust income, and you'll create a second payout, which is non-trust income, putting it in the non-trust components. Now, it's likely you probably can only really do this at year end, when you know what those component breakdowns are. During the year for trusts, you're not going to know what components need to go where, because the providers themselves don't know. That's normally only after the tax year is finished that they'll issue these annual statements, and everything will be kind of will come out in the wash.